What is performance? Performance is an F1 race car engine roaring at 20,000 RPM, allowing the driver to attack the corners like lightning and storm past the finish line. Performance is a fighter jet dominating the skies at Mach 2 and striking its target within the blink of an eye. Performance is a sprinter exploding out of the gate, generating a ton of force in less than a tenth of a second. In a world where mediocrity is considered acceptable and winning optional, investors face immense uncertainty when it comes to wealth creation. There are mixed messages everywhere, and our economic future is determined by only a few. From the market makers to financial advisors to the media houses, there is a lack of clarity in the markets. There are a lot of questions when it comes to wealth creation. We have the answers. Performance Capital disrupts the investment ecosystem by bringing you access to unparalleled opportunities that perform regardless of the market conditions. By investing in medical real estate, you can access the recession-proof asset class that was once deemed unreachable. All of this through a 100% digital, self-directed platform. It's time to reach a higher level of performance. Performance Capital. Investments that perform.
Good afternoon, everybody. How's everybody doing today? We're good? I know we're at 4 o'clock, so hopefully the caffeine intake you guys have all had will just keep you awake for another 20 minutes. The other good news is in 20 minutes you'll be that much closer to your beverage of choice this evening. I'm Sunny Mathru from Performance Capital. This is my colleague Raza Khan, Executive Vice President. We're going to talk to you about the medical real estate today. So quickly to go through the agenda here, opening remarks, so we're going to start with that. Who are we? A little bit about us. Something special we call the blueprint, so we'll save that as a surprise for you. Why are we here, our portfolio, and a little bit about the product, because I think that's what you really want to understand. So we've got 3 arms. Our company consists of 3 arms, and these have evolved over a period of time. Today, we currently have $45 million under management in our medical portfolio, 15 years of providing competitive annual returns. We have 275 retail and some institutional investors. Fidelity is one of them. You may have heard of them. Over 60% of our investors are repeat investors, and some of them we've known as long as 15 years, actually. Led by an experienced management team. There's 4 of us from that management team here today. 2 of them are up on stage here, and 2 of my colleagues, Narendra and David, are at the back there. So let me tell you about who we are. It may seem like a complex structure, but it's very simple. So in the Performance Capital universe, we have Performance Capital itself, which was really driven out the need to take the business into the 21st century by adopting fintech. We decided that we wanted to put together a technology platform to better serve our investors. And really that's our capital raising, sales and marketing, go-to-market, interface with the market division. We then have DMCC. Some of you may have heard of DMCC previously. It's really the heart of our asset management acquisition division, doing exactly as the label says, managing the assets, acquiring the assets, and then looking after the assets. We have another division which was really born out of the need to create investor knowledge. Many of our investors over the years have come back to us for questions and answers so they can better understand how to make the investment, where to make the investment, what would really suit them. So we put together Investor Intelligence, which is really just a knowledge-based site where you can sign up. We author books. We provide information, not just to our investors, but anybody who wants to understand more about the space that we operate in or generally the market.
So as you all know, you may have seen, we're specialists in medical real estate. And, it's funny, we just had a panel discussion and 4 different speakers had different opinions on what's really going on, right, in the market. And this is not a new phenomenon. I mean, over the last a little while, you'll see the experts have different opinions, government officials, economists. Obviously, we know where things are headed, but when will the bottom be in? How bad are things going to be, et cetera, et cetera. In a quest to design the perfect product for offering for our investors, we went on a bit of a quest. So who has seen Lord of the Rings? Anybody? All right. I hope everybody has. It's been around for a while. Like the Fellowship of the Ring, you know, we kind of went on a quest. We dug through the truth a little bit, through the facts. We did a little bit of research to find out what's really going on. And obviously, and also to keeping our investors' appetite in mind. We wanted to see what's really going on. We have a lot of accredited investors like you. We also have international investors that are part of our, that are subscribers. So that quest led us to dig through the facts and compile all that research. And as we got deeper, we decided to write a book. And the book is called The Blueprint. And because everybody here stayed till the end, as a token of our gratitude and as a gift to you, we're going to be giving it away to you. It's an ebook. It's not a hard copy, but come see us right after, and we'd be happy to give you your copy as a gift.
I think the panel earlier was excellent, and it's a good segue into this slide, actually. We're in uncertain times. We all know that. Nobody really knows what's going to pan out, how this is going to pan out. We can make some good guesses. There's historic data we can look at. And we know some information. High interest rates, we have inflation, and we know what the Federal Reserve is trying to do. The point here is, as investors, we have to tread very cautiously. We know we're going to be in a cycle of potentially slow growth. So the question becomes, what do we do? I could spend 10, 15 minutes or longer going through each one of these points, but we don't have the time. But if anybody wants a discussion on any of these issues, I'd be more than happy to take that offline, or you can come to our desk afterwards. So let's look at the market trends, because I think we have to understand some of the basic market trends to understand what kind of product is going to work for us today. So during uncertain economic times, spending behavior changes, so it's important to watch consumer spending. What are some of those changes? Well, people go back to basics. What are basics? Staples, non-discretionary items are the most common. But we also see healthcare as one of those items. People will not stop spending on healthcare. So it can be considered a staple type product. So let's give you some data, because we all love some data. And this particular chart will show you the blue lines indicate healthcare. It's the third one down. And this chart is dated as of August 22, 2022. And it shows you the spend year to date. And you can see that it's one of those classes where spending continues to increase. Right, medical real estate, the recession-proof asset class. Well, anything that's going to be staple-based, you could argue is going to be closer to recession-proof than anything that's not. This is one of the reasons why we like medical real estate, and so do our investors. So today the portfolio consists of 17 medical buildings, and it's growing. 55% of our tenants are national tenants, so we're talking about publicly listed tenants, stock-listed tenants, and our regional tenants are equally strong, with strong balance sheets. And that approach is by design. We deliberately weight our tenant base that way. And a true test of any asset class is during tough times. And what I want to demonstrate on this slide is how the occupancy rate held up during the last recession, which was the pandemic, where a lot of office buildings, retail buildings, and other asset classes were in pain. You can see from our statistics here that we had a very high occupancy rate anyway, and during 2020, the impact was negligible. And in 21, we were actually we were actually higher than we were prior to COVID. Another important fact about that, those occupancy levels far exceed what an underwriter would typically want to underwrite any lending. Okay. So a little bit about our proprietary formula. We have medical, primary, and secondary care. So many of these properties are surgical centers, dentists, doctors. The tenants are extremely established, highly stable national tenants. There's always value add potential on these properties, either by improving them aesthetically, improving the net operating income, improving the quality of the tenant. Economies of scale. We operate in Central Florida. For us, that means within 2 to 4 hours drive of Orlando. So we get economies of scale from there. We have a detailed due diligence process internally. It's almost 100 pages. It has to be signed off by various functional internal departments before we actually move ahead with an acquisition. And property management. We choose to do all our property management in-house. We've been doing that for over a decade. There are many, many good property management companies out there, but we found where we're in control of our own destiny with regards to property management, typically it serves us better. What does serve us better mean? It means we've got better retention rates, we're able to negotiate better leases, our tenants are generally happier, and because we have some national tenants, they often require a very close touch, a personal touch, and we're able to give that to them by not using an intermediary. To give you an idea, I mentioned Central Florida, so this is what we see as Central Florida. There's a list of the 17 properties, and some of that information's also available in the brochure out on the desk. But just to give you a visual of some of the properties we have, all of the properties in this fund. Quick glance at some of the tenants. I mentioned we have some national tenants and some regional tenants, strong ones. Some of you may recognize some of those brands there. Okay, I'm going to go through some of the properties briefly. So this is a building we have at Palm Harbor. Advent Health is our tenant. Advent Health, very strong brand. They're actually headquartered right around the corner from our offices in Altamont Springs. We're located in Altamont Springs. And they recently had a desire to take on the units next door, which means they'll be occupying the whole building. Again, a nice value add. Here's another example. Here we have the Ocala Veterans Affairs building. So this is a government tenant who's been with us for some time. And they've recently reorganized themselves to turn this into a physio place. Previously it wasn't, and they've outsourced the entire renovation and work to us as their landlord instead of using any of their contractors. And that's currently underway. So one more just to give you another indication. Lake Mary Surgical Center. Again, another very strong tenant with a very strong balance sheet. The equipment alone in that building, I've been through it, is probably worth 10 times the real estate. So when tenants start to invest that kind of money, they're not going to move anywhere in a hurry, typically. They've also taken on the building next door, which we've owned for a period of time. And again, it talks to the strength of the tenant.
So the good part about being the last presenter is that all the material has been covered already. It's great. My job is quite easy. But you know, we talked about this in a couple of other presentations today, that there are two primary types of products, as you know. There are growth products, and then there's equity products and debt products. And depending on the cycle, the economical cycle we're in, one of those products is more appropriate. Typically, in a growth economy, equity-based products do very well because they obviously take advantage of the uplift, the capital gains. And in a declining market, where you want to play safe, it's funny, during the recession or during the pandemic, everybody was saying cash is trash, but now all of a sudden cash is king again. So it's good. In those kind of situations, debt-based products do very well. So in our quest to create this product, we basically came to the solution. Right before this, we had an equity product And the latest offering that we have is the Performance Medical Income Note, which is a promissory note that gives you a fixed coupon payment, a quarterly coupon payment. There are two different options you can go with in terms of the term. And this product is based on the 506C Regulation D of the SEC. And with it, obviously, you get a nice mix of assets, 85% medical, and we still have about 15% non-medical, including office and retail. And either you can go with a 1-year horizon or a 2-year horizon. And obviously, the best part is that it is eligible for the 401k or IRA plans. And the returns are either 7% or 8%, depending on the time horizon that you're choosing. So just for your visual reference, that's what the offering looks like. Yeah, so we've concluded, we've covered all the material sooner than we thought. When we were planning this presentation, we thought it would take a lot longer, but that's cool. But as promised, you are, come see us please at the booth if you're interested in getting your digital copy of the blueprint. And about the performance blueprint, I just want to say we studied a lot of data from the past, what other past recessions look like. We call it the ultimate guide for accredited investors to navigate the post-pandemic world. So that included, looking into what other recessions look like, what the ideal appetite of accredited investors is. So if you're interested, please come see us. In any case, we'd love to talk to you. We're right on the other side of the wall there. So
okay, so I guess if we've got time for questions,
yeah,
we'd be happy to take some questions.
Do you guys have any equity offerings at all, or is it 100% debt?
So our last fund was an equity play, and given the changes anticipated in the market, we've now put together, and based on the feedback we got from our investors about concerns about growth, we put together a debt product. We are actually putting together another equity product, which we would like to launch once we see interest rates go in a different direction, which we anticipate for next year sometime. So that's the answer to the question. So today we do not have an equity product that we have launched.
May I just make a comment on that? So we think, we all know, we talked about it earlier in other presentations too, there will be a great buying opportunity that will present itself soon. So when that buying opportunity comes, and we don't believe it's there yet, that is when we're going to be launching the equity product, but we are planning it.
Past equity products,
The performance has been very well. We did have a lot of international investors in that product. We were yielding 8% a year, and we're just in the process of winding down that fund now.
so is paying a current yield on top of that?
Was there what, sorry?
Was there profit on top of the?
So it's due, we'll know at the end of this year, end of next year, because we're due to close it by the end of next year. So anything left after the calculations are done, we'll be able to provide that information at that point.
How do you pay off how do you handle the liquidity of the notes, pay off those notes when they come due?
So there's sufficient yield within the portfolio to cover that. We've done the calculations, and with these notes being 1 to 2 years, and the fact that most of our portfolio is on fixed interest rates because we fixed before the interest rates started going in the wrong direction, we believe that we can support that liquidity. They are secured by the fund. Yes, that's absolutely correct. So this is a corporate guarantee. It's corporate debt, if you want to call it that, and it's secured by the fund.
How does the medical space differ from traditional office space or retail space? What makes it unique?
I think history has shown us that it can certainly be less volatile. I think the pandemic is a good example of that. We saw that office and retail, particular areas of office and retail, suffered somewhat. And going back to the earlier occupancy numbers that I shared, we've clearly demonstrated that the impact was negligible to our medical portfolio. Physically different? So I guess it depends on, just to make sure we're comparing apples for apples, many of our buildings are either single-tenant, standalone buildings. Some of them are multi-tenanted buildings, and they range between a particular square footage. So when we say office, are you thinking of similar size buildings, retail buildings? So physically, I guess location, where they're physically located makes a big difference. But the build quality is going to be just as good. But some of these are in plazas where there may be other retail. Some of them are standalone, as some of the pictures earlier were identified. But did I answer your question? Okay. Yes. Yes. So, oh, okay. So let me clarify. Correct. So there's tenant improvement, and we find in this space, depending on the tenant, they'll want to spec out the building internally, certainly, to what they need. And that's a great example. Surgical center will need surgical grade air conditioning. I'm not an expert on medical equipment, but I would imagine it's surgical grade air conditioning equipment, surgical grade seals, internal doors, depending on the nature of what they're doing, compared to doctors and dentists that may not require that level of spec. So it really varies. What we do know is that this asset class does spend quite a lot on TI based on the medical space as a whole.
I just want to add one thing. On a high level, we love medical real estate, we love healthcare, and the reason why, especially in Florida, is because as a sector on a high level, it is poised to take advantage of this massive population shift that's happening, right? We have the aging population that loves to retire in Florida. One of the things that population has requires is healthcare and medical real estate. And Central Florida, especially with Disney and whatnot, it's like this is the second largest, second most frequently visited city, if I'm not mistaken, after Las Vegas in the United States. So as a sector, we love real estate. We know that snowbirds and seniors love flocking down south, and it supports that strong demand. And we predict that strong demand will continue to drive demand for medical real estate.
Okay.